Hello everyone. The purpose of this video recording is to go through scenario analysis of the test 1 for level 1 for 2019. Basically, the objective is to help students with breaking down scenarios and making the most of their 30 minutes reading time. So from the first paragraph, all we see is that Cement Production Plant Limited, CPP, is the company we're dealing with. Most important part of this paragraph is the last line, where it says CPP has a financial year end 31 December. 2018 financial statements are authorized for issue on 31 March 2019. Immediately from just reading this, we start to think of IAS 10, events after reporting period. Continuing on, in the second paragraph, it talks about CPP and basically what they do. This paragraph would be more relevant to a math test, and therefore there isn't much we can derive from this for financial accounting purposes. Reading 1. The following information relates to CPP. Note number 1. Contracts with local customers. Contracts with local customers stipulate that all orders must be paid for in a full month before delivery by CPP. In the event of CPP failing to deliver, CPP is obliged to source cement of similar quality for its customers from other cement manufacturers. CPP manufacturing's plant was closed on 22 December for the annual shutdown and maintenance, when the cost of production was $300 per ton. The costing department has advised the finance director that the dollar to rand exchange rate had further deteriorated since 22 December 2018, and the production of CPP cement was estimated to cost $360 per ton as at 31 December 2018. So for a student who's very familiar with the IAS 37, they immediately start to think of possibility of provisions, specifically onerous contract. However, reading on, at 31 December 2018, CPP had firm purchase orders for 120 tons. So then we need to underline order for 120 tons of cement from its local customers at a selling price of $350 per ton, which were fully paid for and expected to be delivered in January 2019. We go back to the previous paragraph. The original cost was $300 per ton, but because of changes in the exchange rate, it went up to $360. Now, an order was already paid for at a selling price of $350. So it's pretty clear that for them to fulfill this order, it's going to cost more than what they're receiving. And then immediately we can say this is under IAS 37. Under IAS 37, there's a specific subsection that speaks to contracts where the economic benefits are less than the cost of fulfilling them. And this is para 56 of IAS 37. Speaks to onerous contracts. Going on, the inventory on hand at 31 December was 50 tons of cement at a cost of $300 per ton. There were no raw materials purchased or at hand as at 31 December. So from this information we have received, we are saying the order is worth 420 tons. How many tons do we have on hand? 50. Thereby meaning that CPP needs to source 70 tons from an external party. These 70 tons, however, will be sourced at a price that's higher than the contract revenue they expected to receive. So immediately we know there's a possibility of an onerous contract. But remember, onerous contracts are only to the amount over and above the selling price. So we're saying onerous contract for 70 units. To what extent is it onerous? We'll probably looking at $350 which is the revenue, minus the $360. We get 10. So there will be an onerous contract most likely for 70 units at a value of $10 per unit, giving you 700. Continuing on. The CPP Finance Director has engaged you as an advisor in the cement contracts as at 31 December. Apologies. The CPP Finance Director has engaged you as an advisor in the finalization of the 2018 financial statements. He is of the opinion that all the unfulfilled cement contracts as at 31 December are loss-making contracts, as the cost of manufacturing the cement at 31 December exceed the amount the customers paid when the orders were placed. He has therefore suggested the contracts be recognized as onerous contracts, as per IAS 37, provisions, contingent liabilities, and contingent assets. So now immediately we know there's a possibility we're going to be asked to discuss whether the contract is indeed onerous or not. From what we have derived from the top and calculated, it seems like it definitely is onerous. He is also anticipating that 2019 is a tough year and is likely to result in potential operating losses. He suggested that to be prudent, a provision for the possible losses should be recognized in the 2018 financial statements. If we read IAS 37, or from our knowledge of IAS 37, there is a specific paragraph that speaks to this. And that paragraph prohibits the recognition of future expected losses. Moving on to page 2. Note 2. Assets of CPP. CPP owns the following assets. CPP acquired an office building on 1 January 2014 at a cost of $360,000. Now we need to determine what financial year we're in. Therefore, remember, we go back. What year end are we? 31 December. And we're referring to the 2018 financial statements. The building became ready and available for use on the same date it was purchased. The building has 5 floors. That doesn't seem too relevant at this point in time. CPP has since used 1 floor for its administration function and rented out the other 4 floors as offices. So now immediately we see there's a split of floors. So therefore, our 5 floors, 1 floor is for the admin function, and other floor 4s are rented out. Now, the floors that you use for admin function, remember our asset standards in terms of buildings. Where could they fit in? Possibilities are IAS 16, IAS 40, and we can even go as far as IFRS 16. Now remember, for building to be IAS 16, it has to be owner occupied and being used for more than 12 months. For building to be IAS 40, you hold it for capital appreciation or to collect rentals. For building to be classified under IFRS 16, we would have to be leasing it, recognizing the right of use. Or it would be a building leased out under a finance lease. So, the 1 floor for administrative function is most likely to be IAS 16. The floors rented out are likely to be IAS 40. However, we don't just stop there. IAS 40 only recognizes floors that are rented out under operating leases. If it's a finance lease, we then look to IFRS 16. So, continuing on. The building floors can be sold separately. This is relevant to IAS 40 in terms of determining whether we can classify the buildings separately in different standards, or we have to recognize them under one standard. And then it goes on to say the buildings can also be rented out separately in finance leases. So the key word here is, I would say, can. So if our buildings are held for capital appreciation or to collect rentals, we said they are IAS 40. However, we said if they are leased out under finance leases, they don't fall within the scope of IAS 40. However, it only says that these buildings can be rented, not are actually rented, and therefore they would be able to be classified under IAS 40. The fair value of the office buildings were 475,000 as at 31 December 2018. However, in the prior year, 2017, it was 465,000. So now we've established we need to split our classification of buildings into two components, IAS 16 and IAS 40. Remember, for IAS 40, we're going to have fair value adjustments, and for IAS 16, we're likely to have revaluations or possible impairments, or basically if it's the cost model, we don't recognize gains in fair value. So we go to the additional information and determine what cost models used. It says PPE subsequently measured using the cost model. So therefore, we don't expect to see any revaluations. And it says only the exception of land, which is measured using the revaluation model. Moving on, investment property is measured using fair value model. We can then go back to our page and then say IAS 40, IAS 16 is cost, IAS 40 is fair value. Remember, we cancel out IFRS 16. Okay. Now, going back specifically to our fair value measurements. Remember IAS 16, we're not going to recognize any gains in the fair value. Therefore, we wouldn't adjust. However, when we do recognize fair value adjustments, it's only to the extent of IAS 40. So now we know that when we do calculate the fair value adjustment for our IAS 40, we're going to say fair value adjustment times 4 over 5. Okay, moving on. Office buildings have always been estimated to have a useful life of 30 years. Now, this specifically applies to the IAS 16 component of our office building. Remember, if we're carrying it at the fair value, under the fair value model, we are not going to depreciate that asset. So, with no residual value also. The estimates have remained unchanged, so there's no change in estimate here. Each of the 5 floors of the buildings has equal value. So that then goes to corroborate our thinking of apportioning based on floor space and assuming that each floor has equal value, but now it's been confirmed. Moving on. Note 2.2, factory building and plant. CPP owns a factory building. Again, it was acquired on 1 January 2014. Remember, we're in the 2018 financial year at a cost of 544,000. On the same day, the factory was fitted with plant acquired at a cost of 245,000. So now we need to distinguish that we have a building and we have plant. Now we would expect these two to have separate depreciation rates immediately. Both became ready and available for use on 2 January 2014. For accounting purposes, there would be no need to depreciate based on the number of days. You would be within your rights to assume that 2 January and 1 January are more or less the same and just depreciate it for the full year or using months. The plant requires a major inspection after every 5 years at a cost of 5,000. Now we need to realize that for inspection costs, we can capitalize them to the asset and we depreciate them till the date of inspection. For inspection costs, there is no need to take into account the time value of money. So each year, once we capitalize the 5,000, we'll simply say 5,000 over 5 and reduce the carrying amount of the plant by that each year. An inspection was conducted on 1 January 2019 for 5,000. Now this happened after year end. The useful life of the factory building is 25 years. So our 544,000 will be depreciated over 25 years, whilst that of the plant is 10 years. The factory building has a nil residual value. Due to the nature of the chemicals processed by the plant, CPP is required by industry regulations to, keyword here is, dismantle the plant at the end of its useful life and safely dispose of scrap, as not doing so can result in health hazards. The dismantling cost is expected to be 27,000. Okay. At the time of dismantling and the disposal of the scrap is not expected to have. Dismantling cost is expected to be 27,000 at the time of dismantling and disposal of the scrap and is not expected to have any material value impact to CPP. Now, for this dismantling cost, we need to present value it because this cost is only going to be incurred after 12 months. In this case, it's going to be incurred in 10 years' time. So therefore, when we calculate our dismantling cost, the present value of it today in is equals to 10. We need to determine, are we given an interest rate? Remember, going here, assume a discount rate of 8% per annum before tax. Now remember, for discount rates, we will always use pre-tax rates. So that 8% is correct. I will be equal to 8%. Future value will be equal to 27,000. What payments are we making in between this period? 0. And then what we're looking for is the present value, which is what we'll solve. So, in terms of this factory building and plant, at initial recognition, we're going to recognize the building itself. Okay. And then we're going to recognize the plant at the cost itself plus the inspection cost. Remember, no present valuing. Plus the inspection here, as well as the dismantling cost. And for these ones we agreed, we take into account time value of money, so we PV it. Continuing on, it says, on 31 December 2018, the value in use amounts of the factory and plant were 245,000. So this is value in use, 245,000 and 130,000. Whilst the fair values of the factory and the plant were 260 and 132,000. Costs of disposal are 5,000. This speaks to IAS 36, impairments. And remember, impairments, we are comparing the carrying amount to recoverable amount. Recoverable amount is equal to higher of fair value minus costs to sell and our value in use. So now the most important thing is our value in use is given. What's the fair value less costs to sell? Remember, costs of disposal are 5%, so therefore our fair value will be equal to 100% minus 5%. i.e., we would then say for the factory 260,000 times 5% of minus 5% of 260,000. Or alternatively, you could just do it straightforward and say 260,000 times 0.95. Whatever answer we get there, we compare it to our value in use, and that's our recoverable amount. This amount will help us to determine whether our buildings and plants are impaired or not. Okay, so proceeding on to note 2.4. Note 2.4 speaks to a website. Immediately we know websites fall under IAS 38 and SIC 32. So, as part of its strategy, CPP endeavored to improve on its adaptability to technological changes. The strategy included developing a CPP website that would interface with retail customer systems to identify when their cement inventory was running low and needed to place an order to replenish. Once the order has been raised, the client must approve the processing of the order by making a payment for the order. Payments are done via the website EcoCash platform, a local mobile money transfer system. CPP has signed 10-year contracts to allow them to use the inventory management system of CPP via the website in exchange for only making their cement orders with CPP. After 10 years, it is expected that technology will have improved, rendering the inventory managed system used by CPP obsolete. An amount of 20,000 has been allocated to the website development in CPP's budget, set in 2017 at the final planning meeting. The amount is based on Tim Nyoni, a reputable website developer's quotation. So immediately from this, remember 632 gives us guidance on what to do with websites and their development. It guides us on whether to capitalize them, all costs incurred, or whether to expense them. So now remember, if a website is going to generate economic benefits through customers making orders and possible payments, it's capitalized. If it's just a website for advertisement purposes, then we would most likely expense those costs. Continuing on 7 January 2018, CPP's management undertook the project and engaged Tim Nyoni to develop the website. Let's go back to the date. On 7 January. This could possibly be the date where the development phase starts. So, looking at the costs. On 13 February 2018, CPP carried out some feasibility studies. Do these qualify under research or development? So I think we need to determine R and D. Where do they qualify? So feasibility studies. Do we capitalize or do you expense? Most likely we would be expensing them as they are part of the research phase. And it therefore says, on this date, the feasibility study proved the project to be viable. Management committed to this day to funding the project. We also might need to consider IAS 38, para 56, I think. Day management committed to funding this project. So, most of the costs we incur thereafter are likely to be development cost. Purchase of a domain, development cost. Designing of the website and actual testing, likely to be a development cost. Updating of graphics. On this date, the system developed a glitch and started recording orders not processed by the retailer. So this could be a development cost, or it could be after the asset is in use. Therefore, we may need to expense. Also an update. That's probably not part of development, but it still could be. And actually, the development fees we paid to Mr. Tim Nyoni of 2,500. This would be part of the development phase. However, it says these costs were not yet paid. But remember, they were part of our development, and whether they were paid or not, we would still be able to capitalize them because we have the liability. Moving on. The management of CPP was fully convinced that the work done by Tim was substandard and did not find any reason to pay for the work done as the website was not achieving its intended objective. So the website was not achieving its intended objective. The keywords are management was fully convinced. However, there is no proof. So now there could be an issue under IAS 37. Is this amount, this payment itself, is it still a liability? On 30 June 2018, CPP terminated the contract with Tim and refused to make any payments related to the outstanding 2,500 of the development fees. So they just simply refused to pay him. Are we keeping this liability? CPP was citing failure by Tim to deliver the contracted product, although the cause of the glitch had not yet been identified. So there is no confirmation. The lawyers of CPP had advised that the course of action taken by management on this matter would breach the contract signed with Tim. So the lawyers are more or less confirming to them that yes, the liability still exists. On 1 September 2018, CPP engaged Web Solutions to take over the website development project. Web Solutions started by making an investigation into the cause of the glitch. So this happened during year-end. On 5 January 2019, Web Solutions presented the investigation findings to CPP, which reflected that the website had been completed and was ready for use on 27 June 2018. Most important part here is it happened on 5 January. This happened after year end. We then start to look at IAS 10 as we highlighted before. Remember, IAS 10 is split into adjusting and non-adjusting events. Web Solutions presented the investigations and reflected that the website had been completed and was ready for use on 27 January. This is when this should have been amortized. That's the date we start amortizing this asset. However, it was hacked when it went live, and this is why it did not function as intended. So from this information, it is pretty clear that Tim had fulfilled his obligations. Contractual obligations, that is. On 10 January, Web Solutions deleted the bug for $500. So this amount here, we can write as an expense. And after that, the website started functioning properly. On the same date, CPP made a payment of $2,800 to Tim to settle the development fees, including $300 as a late payment penalty. Remember the date. 10 January 2019. Again, this was after year end. But there is confirmation that Tim had fulfilled his obligations and CPP was wrong. So, to the extent of $500, we would most likely recognize a liability, which is what they should have done in the first place correctly. To the extent of this $300, it happened after year end. So now we may need to determine is it an adjusting or non-adjusting event. Last statement reads, penalty is not deductible for tax purposes. Not deductible. Therefore, we know immediately this penalty gives us a permanent difference. Why? Because the accountant is giving himself a deduction. However, the taxman is saying you will never get a deduction. It's not a timing difference. It's therefore a permanent difference. So from this paragraph, we identified there's possible issues relating to IAS 37, IAS 10, and IAS 12, deferred taxes with the permanent difference. Continuing on, note 3. CPP's profit before tax for the year end was 734,000. The profit before tax include all the transactions in this scenario with the exception of the information in note 2.1 that is yet to be accounted for. So, note 2.1. So from this, we need to go back to note 2.1 and see what it's talking about. It's talking about our office building. We identified there's depreciation, there's fair value adjustments. So now we go back to our page 4 and see that we need to say 734,000 plus or minus depreciation, and if we add adjustments. And also we need to remember this standard is embedded throughout all our other standards, IAS 12. It then goes on to say the following items are included in our profit before tax of 734,000. Local dividend income, tax exempt. Remember, that's another permanent difference. Christmas dinner is not deductible. The accountant would have deducted it, but the taxman is saying they never will. Gives you another permanent difference. ZIMRA, tax penalty. Again, this is another permanent difference. Foreign income tax gives you another permanent difference. Why? Because this amount will be subject to foreign tax. However, ZIMRA, the accountant will have charged tax at 25.75% in their books. So there's 25.75% charged by the accountant. However, ZIMRA will not tax this amount as a result of the double tax agreement. So that is basically a breakdown of our scenario. We need to take note of 2.5. We need to take note of the allowances given. So ZIMRA allows capital allowances, commercial buildings 2.5% per year. What commercial buildings do we have here? We have office buildings and investment property. Industrial buildings would be our factory, and then plant and equipment is obviously going to be our plant and equipment that are given. So website costs are deductible in full. So you get all the allowances in 1 year. However, the accountant will have a carrying amount over the period in which the website will be used. So the most important thing about CGT, remember, we have directly through P&L, and then we have we have deferred tax through CGT. So IAS 12 is split into through P&L and through CGT. And we need to remember for CGT we need to have capital allowances and the inflation allowance. Why are we saying we need to remember capital Sorry, apologies. So I was saying for CGT, we need to remember inflation allowance. For P&L, we need to remember capital allowances. And we need to remember we have IAS 40, investment property. Remember, it's going to be both through P&L and through capital gains and tax. This is what we still call the tree of life. So that's basically a breakdown of our level 1, test 1, 2019 scenario. Thank you so much and all the best with attempting it.